Picture this. A small country finally gets a chance to build the road, port, power plant, or airport it's been promised for decades. Politicians cut ribbons, construction crews move in, the GDP forecasts look brighter. And for a moment, it feels like the future just showed up on a cargo ship. But then the bill comes due. And that's where the real story starts. Because China's overseas lending isn't just about building stuff. It's about shaping the choices those countries can make later. Not always through some movie-style plot, but through contracts, repayment pressure, and the quiet leverage that comes from being the lender when nobody else will write the check. First, let's be fair. Poor countries need infrastructure. And Western lenders and institutions often move slowly, demand reforms, or won't finance certain projects at all. So when Chinese banks arrive with fast money and big promises, leaders listen. China's policy banks and state-backed lenders became some of the biggest players in this space. And what makes the system powerful is that it's not only finance. It's finance tied to construction, equipment, and political relationships. Now here's the part most people miss. Control doesn't have to look like taking over a country. Control can look like forcing trade-offs. It can look like making a government choose between paying teachers or paying debt, between buying medicine or keeping a currency from collapsing, between telling voters the truth or hiding the terms of a deal. One reason this model creates leverage is the way many of these deals are structured and handled. When loan terms are hard to see, the public can't judge whether a project is a fair deal or a political trophy. Citizens can't pressure leaders to renegotiate early, and other lenders can't accurately price risk. In a crisis, secrecy turns into leverage because the lender knows the real obligations while everyone else is guessing. And secrecy doesn't just protect the lender. It protects the politicians who signed the deal. If voters knew the fees, the triggers hidden inside default clauses, or how much flexibility was signed away, some projects would collapse under public pressure before a single payment is due. When details stay hidden, accountability disappears, and leverage quietly grows. Another mechanism is cash control. Some loan structures prioritize repayment in ways that can pull scarce foreign currency away from a country's normal budget needs. In plain English, the money that should keep the lights on, stabilize imports, and fund basic services can get squeezed by repayment schedules that don't care about elections, recessions, or food prices. Then there's the refinancing cycle. A lot of countries borrowed heavily during the era of cheap global money. When interest rates rise, currencies weaken, exports slow, or a shock hits, debt service becomes a trapdoor. And once a country is desperate for dollars, the biggest creditor doesn't need to take anything. The creditor can shape choices simply by deciding when to extend, when to delay, when to restructure, and on what conditions. Here's how that control feels on the ground. A finance minister sits down with a spreadsheet of payments due in the next 90 days. Fuel imports, food imports, medicine, and salaries are all on one side. Debt payments are on the other. If the country misses a payment, credit ratings drop, the currency falls, and the cost of everything spikes overnight. So leaders scramble for bridges, not solutions. And the pressure isn't only financial. When contracts include broad default triggers, cross-default language, or terms that keep deals out of public debate, the lender gets a stronger bargaining position in every future negotiation. Even when nothing is enforced in court, the threat of acceleration is enough to shape behavior. Some deals also lock countries into specific vendors and timelines. If a project runs over budget, the borrower often has to borrow more to finish it, because an unfinished port or power plant earns nothing. That's how one loan can turn into two, then three. And suddenly the country isn't choosing new projects, it's refinancing old promises. At that point, control doesn't look like a takeover. It looks like dependency. The lender becomes the gatekeeper for maturity extensions, grace periods, and new money. And when a gatekeeper can say yes or no, the borrower's foreign policy starts to quietly adjust. Debt is also about timing. A country can be solvent on paper and still get crushed if cash flows don't match. When repayments spike in a single year, leaders cut maintenance, raise taxes, and sell future revenue for today's dollars. That's when projects meant to build independence can end up shrinking it. It's leverage in slow motion, built into the payment calendar, month after month, crisis after crisis, and election after election, again. Now let's talk about the example everyone brings up, Sri Lanka and the Hambantota port. You've probably heard the simple story. China lended money, Sri Lanka couldn't pay, China seized the port. That version is catchy. But the real story is more complicated. Depending on how you look at the deal, you can argue about whether it was a seizure, a lease, or a liquidity move driven by a broader debt crisis. But here's what matters either way. When a government is under pressure and it needs a big chunk of foreign currency fast, it starts making decisions it would never make in a healthy economy. And once a creditor becomes the escape hatch in a crisis, that creditor gains influence. Not necessarily formal ownership, but something more flexible. Options. And options are power. This is the core pattern. China doesn't need to own a country to shape it. It just needs to be the lender when the borrower has no good alternatives. And here's where control shows up in policy decisions. When a country is trying to restructure debt, it often needs major creditors aligned before broader deals can move forward. That can delay relief, prolong recessions, and weaken governments politically. Meanwhile, leaders may hesitate to criticize China publicly, vote against China in international forums, or restrict Chinese firms because the next rollover, the next grace period, or the next investment decision might depend on staying in good standing. There's also a commercial angle that matters. Many loans are tied to using Chinese contractors, Chinese equipment, and Chinese project execution. That can speed construction, but it can also mean the borrowed money exits the country quickly, while the country still holds the debt. If the project underperforms, the public eats the downside, but the contractor already got paid. And when projects aren't viable, the consequences aren't abstract. It's higher taxes, higher inflation, currency stress, and cuts to public services. Debt service becomes a silent priority over everything else. The pain is felt by ordinary people long before it shows up in headlines. So if you're watching this in the USA, why should you care? Because this isn't only about faraway politics. It affects commodity prices, shipping routes, migration pressures, and global stability. It also changes how alliances form, because money is a language governments understand faster than speeches. Now, I want to be careful with the conclusion. Not every Chinese loan is predatory. Not every borrower is a victim. Some countries do get real infrastructure and real growth. And many disasters start at home, with corruption, bad planning, and leaders who gamble with public money. But the structure of lending can still create pressure points that a powerful creditor can use. So the real question isn't, is China evil? The real question is, what happens when the world's most aggressive lender uses contracts, secrecy, repayment pressure, and crisis-time bargaining to shape what poorer countries can do? Because once your country's budget is built around debt payments, your sovereignty stops being a flag. It becomes a math problem. If you want more breakdowns like this on debt systems, sanctions, currencies, and global power, subscribe to Frankie Finance. And in a next video, we can map out the exact pressure tactics creditors use when a country runs out of cash and what it means for the next decade of global politics.